It's Wednesday, 30th of October, and this is your Capital Economics Weekly Briefing. Or call it your mid-weekly briefing, actually, because we've just had UK Chancellor Rachel Reeves' debut budget statement to the House of Commons, and our UK team has been briefing clients in a drop-in, that's one of our short-form online briefings, on what she said and what it means for macro and markets. The full recording is on our events page, but I wanted to share an extract from it, this one covering growth implications, Bank of England rate implications, housing market implications, and how the financial markets received all of the news. You'll hear Chief UK Economist Paul Dales and Senior Markets Economist Diana Iovanel being quizzed by Andrew Kenningham, our Chief Europe Economist. And it starts with Paul giving his initial take on this much anticipated budget statement.
Well, it was big. It was big both in terms of the Labour government telling us that it's going to use fiscal policy to achieve its political aims, such as more public provision of services and also trying to grow the economy. But it was also big in terms of the actual sums of numbers spent and monies brought in as well. Everyone will already know that taxes will be raised by just over £40 billion, which is a quite chunky 1.2% of GDP by 2029-30. The other thing is that this was more than offset by increases in current spending of just over 1.4% of GDP, so £47 billion, and increases in public investment of £25 billion. So actually the net result is that this budget is a loosening of fiscal policy relative to the previous government's plans. So in my view, it actually means that the economy is going to grow a bit faster in 2025 and 2026 than perhaps previously looked likely. And that's despite that really big increases in taxes over the whole forecast period.
Okay, great. That's a good starting point. And this question, pretty natural one to ask. How do you see inflation and the impact on interest rates? So presumably more likely to push them both up than down.
Yes, I think it probably means that inflation will be a little bit higher than otherwise, and maybe interest rates might not fall quite as fast as we previously thought. So the reason for this is that the increase in government spending happens quite soon. A lot of it happens in this current financial year and the next financial year, and that's the main reason why GDP growth might be a little bit stronger over the next couple of years. And that comes in before the increases in taxes. So it's a net boost to demand there. And public investment, again, that comes in later in the forecast period. Now, public investment does add to demand and supply, but actually you get the boost to demand sooner than you get the boost to supply. So on net, for us, it's a story of inflation perhaps still continuing to fall over the next couple of years, but maybe a slightly bit slower. And because there's a net boost to demand relative to supply, we think maybe the Bank of England might be less inclined to speed up the pace of its rate cuts. It's currently moving at a pace of a 25 basis point cut every other policy meeting. And we think that'll probably continue for at least the next 6 months or so, unlike the ECB, which has recently sped up. The big picture we still think is that interest rates will fall from 5% now to around 3% at their low point, but it just might not be, it might take a little bit longer to get down to that level.
Okay, let's just jump over now to talk a bit about the market reaction. I'll come back to you, Paul, with some more of the economics questions in a second. Maybe, Diana, just start off by telling us, what was the reaction? Seems to have been a little bit of going up and down in terms of bond yields, but where have we got to at this point?
Exactly. I think there was definitely more of a market reaction that we've seen in the past couple of budget announcements, although it's still quite far away from the reaction we've seen after the mini budget in 2022. I think overall yields are up a bit over 10 basis points compared to where they were when the Chancellor started speaking. But I think one thing that stands out about the reaction today is this point we've made before about the difference between what the government is trying to signal, about their focus and about fiscal sustainability and the actual numbers. And I think what happened today was that as Chancellor was speaking, the moves we saw in markets were mainly down. We saw the pound falling a little bit. We saw gilt yields falling a little bit as well. I think maybe 4 or 5 basis points. And then after the OBR report came out, probably around 2 p.m., we started seeing some, the beginning of these spikes, both in gilt yields and in the pound. So I think, obviously, there was a big focus on all the tax raises, and a lot of time was dedicated to that. And I think that signified how policy might be tightened and how, deficit would be lowered. But then when numbers came out, it became obvious for investors as well that actually fiscal policy is being loosened and actually borrowing will increase quite a bit. And I think that's why we saw this spike in yields ultimately.
Okay, and so where are we seeing yields heading over the rest of this year and next year maybe?
So our forecasts are for them to fall from here, and in line with what Paul was saying before, if the bank rate goes down to 3 from 5% now, we expect yields to fall even down to 3.5% by the end of next year. Now, I should say that, with this increased risk now that inflation will fall a bit more slowly, and then the Bank of England might want to be a bit more cautious about cutting rates, that obviously puts a upward risk on our forecast as well. And obviously this discussion is mostly about rate expectations, but I think, the term premia is an important thing to factor in as well. And I think that today there have been definitely signs that the term premia increased as well, meaning that even though the overall moving yield was not that big, and part of that was definitely pricing in that risk of higher interest rates, some of that was probably to do with the fact that overall loosening fiscal policy might mean a bit of pressure on goods from that channel as well.
Okay, great. Thank you. Let's go back to you, Paul. We've had several questions on the theme of growth and whether the changes that have been made are going to do anything significant for long-term growth prospects. I saw a bit of Rachel Reeves' speech, and she was certainly saying that the OBR has endorsed it and said that there would be slightly stronger growth in the long run. Do you think that's plausible?
I think it makes sense. So the key here is the fairly chunky increases in public investment. Now, the idea here is that does increase the supply capacity. It'll perhaps help boost productivity as well, which has been the UK's perennial problem since the financial crisis. Now, the OBR has judged that actually the increase in public investment over the next 5 years that the Chancellor announced today, that doesn't make much of a difference to the UK's medium-term growth prospects in the next 5 years. But it says actually it will increase GDP by 1.4% between 5 years and 10 years' time. Our forecast for long-term growth is actually already quite positive already. So we think that the UK's potential growth rate can rise from around 1.5% now to something like 1.8 or 2% in the 2030s. Now, it's worth saying that most of that actually derives from the work and analysis we've done on how artificial intelligence will boost productivity. And we think that's going to be particularly the case in the UK. So what we're not doing at the moment is raising our own medium-term or long-term growth forecast on the back of what's been announced in the budget. But I view the policies announced in the budget, the idea that there's going to be more public investment, as an upside risk. So if that investment money is spent well and seems to be actually generating an increase in productivity, then maybe we would become even more optimistic on the UK's medium-term and long-term growth prospects.
Moving on to another issue that's come up many times, is housing market. I mean, the government's talked a lot about boosting housing. There were some changes, I think, in sales tax or the tax on the housing transactions. But are there other things in today's budget that will make much of a difference to the property sector?
Yes, there are. So if we talk about stamp duty, sort of the direct policy influences, the Chancellor raised the stamp duty rate for anyone buying a second home from 2% to 5%. That's the extra surcharge on top of the normal rate. The idea being that this will reduce demand for buying second homes and therefore free up a bit of supply for those buying first-time homes or first-time buyers. The thing she didn't mention is what happens to stamp duty itself and the thresholds, because they were due to expire. So there's a temporary increase in the nil rate thresholds that is due to expire in April 2025. The fact that she didn't mention it suggests to me that that is going to expire, although I'd have to check the actual details, which means that anyone moving or buying a home after April 2025 will pay a bit more stamp duty, first-time buyers included. So they're the sort of the direct tax effects, both of which would be expected to reduce housing demand and make it more expensive to move home. Then, of course, you've got higher taxes in general, which one way or another might flow back to households. So that would reduce households' real disposable incomes relative to otherwise. And at the same time, we're suggesting that one of the implications here is that interest rates might not fall quite as fast. So the message really is that mortgage affordability will be a little bit more challenging and housing demand might be a bit lower than otherwise. On the supply side, there's been lots of announcements about new affordable homes, money for affordable homes and social homes. And the government does have this big aim to try and build 300,000 new homes every year. And we don't think that'll be met. In fact, I think they'll fall quite some way short over the next few years. But I still think supply will probably increase. So a combination of slightly weaker demand than otherwise and slightly higher supply suggests that maybe house prices won't rise quite as much. Our forecast is that prices might climb by about 5% next year. So if the budget does anything to that forecast, it may mean that we're a bit more conscious of the idea that prices might not rise quite as fast as that next year.
That was Paul Dales, Deanna Iovanel and Andrew Kenningham discussing the UK budget. There was much more in the discussion. It took in changes to CGT. It took in Rachel Reeves' change to her fiscal rules. Deanna was talking more about the perspective from the bond market, with reference, of course, to that infamous Liz Truss moment 2 years ago. The full recording of the session can be found on our events page, capitaleconomics.com/events. And the UK team will be back online next Thursday, 7th of November, with a drill down on the Bank of England's latest policy rate decision. Look out for details of that session. It'll be on the events page in the coming days. We will be back later in the week with a special preview of the big political event of the year. It's all about the US election, what it means for the US economy, for the global outlook, how it looks from Beijing, what it means for treasury yields, and much more. CE subscribers get access to the podcast via the website. They can get notifications direct to their inbox as they are published. You can also subscribe via Apple or Spotify. But until next time, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.